Well, good morning and good afternoon, everyone, and welcome to Cash Balance Outlook 2017, our ninth annual Cash Balance Outlook webcast. We really appreciate all of you joining us today. I'm going to introduce your main speaker, Dan Kravitz, after do a couple of quick housekeeping items. If you weren't on during our sound check, just a reminder that you do have two options for your audio. If one of them is not working as well as you would like, you can switch between the dial-in phone number that is there on your control panel, or you can try the computer audio. And also on your GoToWebinar control panel, you have a question box and a text box if you want to send us a message. You can pose any questions there. We'll try to get to some of them if we have time at the end of the webcast. Otherwise, we will make sure to reach out to you after today's webcast. And a number of you have already been asking about the handouts. We prefer to email the handouts to you after the webcast because we find that people skip ahead and get distracted. And we have so many delightful goodies and insights for you today that we want to make sure that you experience them in real time. But you will get a full set of handouts. We will also be sending out links to all the various publications and marketing pieces that we mentioned during today's webcast. Videos and anything else that we mentioned that we think will be helpful to you. You'll get a very comprehensive email with links to all of that information. And we are recording today. The recording is usually available within 5 to 7 business days, and all of you who are registered will receive a link to it. So, anything else you want to add there, Dan?
Yeah, before we get started, obviously, our thoughts and prayers are with everybody in Florida and Texas. So, definitely just wanted to give a shout out to those people that are going through that.
Great.
Those
yeah.
issues.
God bless all of you who are struggling in those areas, and we've been doing some fundraising here and sending out our support as well. So I will introduce to you to your main speaker today. Many of you know him and love him already. Dan Kravitz, our company president, and Dan, as you probably know, is one of the nation's foremost experts on cash balance plans. He literally wrote the book on cash balance plans, Beyond the 401k, which is an Amazon bestseller in the retirement planning category. And Dan has been working in the cash balance field for over 20 years. He has designed and helped implement more than 1,000 cash balance plans for businesses of all types and sizes. And he speaks at a lot of national industry conferences. And I don't think that there's no better hands that you could be in today. And some of you may know me already. My name is Martha Ophir, and I'm the marketing manager here. And I do a lot of work on this research report every year. So I'll be filling in some background information and commentary. So we will get right into what our goals are for today.
Great. Thanks, Martha. So, first and foremost, as we walk you through this next hour, we want to make sure you walk away with a clear understanding of what's going on in the cash balance marketplace.
We're going to show you how to take advantage of some of these growth trends that you're going to be seeing in our research.
And then last but not least, we're going to try to empower you with some tips and ideas that you can implement right away in terms of growing your business using cash balance plans. So Martha, with regards to the agenda, why don't you tell us what we're going to start off with?
Great. Thanks, Dan. We're going to start out with some key highlights from the research report. Hopefully all of you have already downloaded it and read all 15 pages, but we're just going to take you through some essential highlights.
It's a riveting report. And then,
riveting.
And then after that, we'll kind of talk about peel back the onion, what's driving this steep growth curve, why we're seeing so much activity in the past 12 months with regards to cash balance plans.
We're going to talk more about taking advantage of cash balance growth, whether you're an advisor, a plan sponsor, a CPA, TPA. We'll show you how you can take advantage of this growth curve.
Yeah, well, I'll then walk you through some trends. I'll even go out on a limb and make some predictions in terms of what I think is going to happen with regards to cash balance in the future. To be truthful, a lot of that depends on what happens with tax reform.
And finally, we'll wrap up with how we can help you succeed. We're going to give you some concrete next steps and just describe some of our tools and programs that are available to all of you today.
So, for those of you that are on this webcast, we're kind of making the assumption that most of you are familiar with cash balance plans. If you're new to cash balance plans, I highly encourage you to visit our website, cashbalancedesign.com. There's some great resources on there to learn about these programs. But again, we're assuming that those of you that have signed up for this webcast, and I believe we have over 600 people signed up for today's webcast, are somewhat familiar and have worked with these programs in the past. But just to take a step back, here at Kravitz, we call cash balance plans the best of both worlds. The reason why we call it that is they're hybrid plans. They're defined benefit plans that have characteristics of 401k profit sharing plans. Kind of has the best of both. You get to take advantage of the higher contributions of DB plans while at the same time have some of the unique features of 401k, flexibility, portability, and simplicity. Anyway, again, this is not a primer on cash balance. This is a high-level webcast in terms of what's going on in the marketplace. Go to our website, cashbalancedesign.com, if you're new to these programs.
Jumping right into our agenda, the first item is looking at highlights from our 2017 research report. And again, that is available for download. Most of you already have the link to it, and it's about 15 pages long. And I'll tell you how we do this. This is our 10th year doing this. Ever since Dan Kravitz first decided that cash balance was going to be a key growth area in the retirement plan market, we started looking at the data. And what we do is we download all the data from the Form 5500. Not the easy, that's a whole different set of data, but there were close to 18,000 last year. 2015 is the most recent year available. And we just go through those looking at all these different data points. We also get some interesting data from the Department of Labor, the EBSA reports, and from the Plan Sponsor Council of America. And then we have a team that goes through everything and puts together a lot of these charts and updates and details.
Yeah, absolutely. And so, this is actually one of my favorite charts from our report. And by the way, this is the 10th year we've done this report. But when you look at this chart, what's really fascinating to see is we've jumped from about 1,300 cash balance plans in 2001 to today well over 20,000 plans. But look at the steep increase in the number of plans after 2006 and after 2013. So remember, in 2006, the Pension Protection Act was passed. There was some, I won't go into it today, but there was some legal questions surrounding these plans, and all that pretty much went away after 2006, after that law change. And then after 2012, when we see a steep increase in the number of these plans, two things happened. One, we got some very exciting new cash balance regulations that made these plans a lot more flexible, a lot more easier for employers to adopt them. And also, I think most importantly in 2013, we had a tax increase. I'll go into that in more detail, but I really think as a result of those tax increases in 2013, we saw a surge in the number of cash balance plans. I mean, look, they doubled from about 9,600 plans in 2012 to 20,000 plans in 2016.
And just to kind of summarize what that looks like, cash balance plans, as you saw on the previous slide, have seen a double-digit increase almost every year since 2006, since the PPA came into place. Cash balance market is still relatively very, very new and full of opportunities, still growing really, really fast. The 401k market, as we've looked at it in these reports over the last decade, has ranged anywhere from like 1% to at the highest about 3.5% growth. So just a really tremendous comparison. Again, the difference between a young, growing market and a really kind of mature, somewhat, I would say, stagnant.
Yeah, definitely. The 401k market, there's no doubt a mature marketplace, while cash balance, relatively speaking, is relatively new. So this is, again, I really like this. I know a lot of advisors and wholesalers that are listening in will pay close attention to this slide. There's well over $1 trillion of assets in these 20,000 cash balance plans. What's particularly interesting is you look at the breakdown based on size. 35% of all cash balance plans are under $250,000. Most of these plans, remember, are startup plans. So typically we see a surge in the number of plans under 250,000, but then look ahead. Look at, we have about another 25% of plans that have about $1 to $10 million. So, after the tax increase in 2012, those plans that we put in place in those past early years of this decade really have matured, have grown quite a bit, and then look at the huge drop-off. This big drop-off has a lot to do with two phenomenons. One is, which I'll talk about later, something that we've seen a lot with our larger clients, something called strategic plan termination. And then also, a lot of Fortune 500 companies have put in cash balance as a way to unwind their defined benefit plans. And those plans, a lot of those have started to terminate and be replaced by 401k plans. Also interesting to note is, annual contributions to these plans are well over $30 billion.
Right. Another really interesting chart that we like to look at every year, and this has got the same kind of sharp kind of ski jump looking curves to it as the cash balance growth chart, is what percent of the defined benefit market is made up of cash balance plans. And if you look back at 2001, it was less than 3%. And then just between 2014 and 2015, it spiked up from 29% of LDB plans to 34%. Again, this is the type of thing we go into a lot of detail in the report about. We have a whole page that looks at why cash balance has taken over the defined benefit market. What were some of those issues for plan sponsors with traditional DB that cash balance helps them avoid? And I think when we talk a little bit more about some of the legislative and regulatory changes, there's definitely a pattern where you can see how the IRS is helping make cash balance plans easier, simpler for plan sponsors to adopt, creating a lot more flexibility around those investments and testing and issues like that.
Yeah.
So a lot of good news.
Yeah, a lot of good news for cash balance. To be perfectly blunt, another reason for this steep curve is a lot of traditional defined benefit plans are going away. I got to be honest, Kravitz has been in business for 40 years, and I can't remember the last time we set up a brand new defined benefit plan. Defined benefit plans, whether we like it or not, are going away, being replaced by both 401k profit sharing plans and, as we show here, cash balance plans. So, this is really interesting, and it really tells the story of what's driving the growth of cash balance plans. Prior to 2006, there was only about 1,500 of these plans. I believe there was probably about 50,000 defined benefit plans back then, about 1,500 cash balance. A bunch of large companies were converting their DB plans into cash balance prior to 2006. A lot of employers were hesitant to adopt these plans because, again, there were some legal challenges with regards to cash balance. And like I said earlier, that went away after the Pension Protection Act. So we start to see a rise after 2006. And then look what happens after 2010. We go from, 3,100 plans to well over, again, our 20,000. Another 12,000 plans are implemented. Again, a couple of things. And our report goes into a lot more detail here, but it has a lot to do with the regulations we got in 2010, which were then finalized in 2014, and really, most importantly, and I'll go into this in more detail, truthfully, the tax increases in 2013, I think, really drove the growth of these programs.
And actually, there's a little piece of Kravitz history in here too, because Kravitz did its first cash balance plan in 1989, when Dan was maybe still in high school.
You're kind.
Yeah. And then, so one of those 100 plans done in 1989 was one of the Kravitz plans done here in Los Angeles for a law firm. And then starting around 2007 was when Kravitz made the big pivot towards a almost singular focus on cash balance. And then you can see that Kravitz's own growth has coincided with this chart itself. So this is a living history chart, and we're a piece of that living history, and proud to be part of it.
Well, thanks, Martha. This is a really important slide, I think, and it's something that we like to point out when we're out there talking to reporters and we're talking to people about these plans. A lot of people that are getting into the cash balance business are focused on the fact that a lot of small business owners, partners of law firms, and medical groups adopt these plans as a way to help the owners and executives reduce their taxes and increase their retirement savings. But because of the discrimination rules, in order to have a cash balance plan, you have to make significant employer contributions to rank and file employees. And this tells a great story. The average 401k plan sponsor that does not have a cash balance plan spends on average just over 3.5% of payroll on the retirement benefits. In 2015, it was 3.7%. But look what happens when one of these 401k employers adopt a cash balance plan. They typically double up on the amount of their benefits that they provide their rank and file employees. That 3.7 jumps to 6.6%. Now, is this because employers are paternalistic and they want to help their employees save for retirement? I hope so. But truthfully, the testing rules require that in order to have a cash balance plan, you have to significantly increase the contributions to the rank and file employees. And what's paying for all this is typically the tax savings that the owners will see. And, at Kravitz, we help a lot of our advisors and TPAs and wholesalers that we partner with, help them explain to their client and put it in real black and white numbers how much money an employer will save in taxes by adopting one of these plans and what the additional cost is. And usually the tax savings far exceeds the additional cost.
Another little set of highlights we like to pull out from this report is what we call our cash balance billboard chart. We look at the regional concentration. Some of this is pretty similar to last year, and there's been some interesting changes. Again, California and New York always dominate, just based on the size of the states, also probably tied to their tax environment and just the large numbers of law and medical groups that are located there. A new up-and-comer this year was Maryland. And again, that might have to do with just a lot of medical groups. We talk about medical hubs a lot related to cash balance that are in and around the D.C. area. And Minnesota used to be on the chart, and I guess things have slowed down a little bit there. And some of the up-and-comers are Illinois, Georgia, Virginia, and Massachusetts are closing in at 11, 12, and 13. And then we're also pleased to say that there's cash balance plans now in all 50 states, plus Puerto Rico, Guam, and the U.S. Virgin Islands.
Very exciting.
Oh, and then Florida, which we've just highlighted that for the fastest growth, so almost 30% growth in new plans. So I wouldn't be surprised to see Florida climbing up into the top 3 next year.
Yeah. So Martha, why is it that cash balance plans are popular in certain states?
First and foremost, we look at medical hubs. As you'll see when we get into looking at the types of businesses, close to 30% of all cash balance plans are in place at medical groups, hospitals, and medical providers. There's a lot of different reasons for that. So any of those cities like your Boston, San Francisco, New York, Dallas areas where you've got a big concentration of medical groups, you're going to see a lot of cash balance plans.
And not to be a broken record, but a lot of it has to do with taxes. Martha pointed out on the previous slide that I think in the 10 years that we've been doing this, California and New York have always led the way in terms of the number of cash balance plans. I don't think it's coincidental that they also have 2 of the highest state taxes. So typically where we see high taxes is where we see a plethora of these plans.
Population and age are big factors. Anywhere where you've got a high concentration of boomers and concerns about delayed retirement savings, you're also going to see an increase in popularity of cash balance plans.
Yeah, and last but not least, what we've seen, and we can actually point to real data, that whenever we find a third-party administrator, a financial advisor, or a wholesaler has decided to focus on cash balance plans, make it a good part of their journey in terms of growing their business, we suddenly see a surge in the number of plans in their territory. So you could impact our presentation in future years if you decide that you're going to work really hard in terms of educating businesses out in your area about these programs.
We're going to look at a couple of slides related to the number of participants in cash balance plans, and what we talk about is both sides of the story. So this is definitely a small business growth story, but there's also a number of plans in place at certain larger firms and in some of the Fortune 500 companies.
Yeah, to be truthful, the cash balance plans that are put into play at the Fortune 500 companies are very different than the cash balance plans that we see and and then where all the activity is at small and mid-sized businesses. Again, the larger employers like IBM and FedEx and Pepsi-Cola, they all use cash balance plans as a way to unwind their defined benefit plan. And I think a lot of that has run through the system, and that's what's kind of kicked this all off. But really, all the activity is really in the micro market. I mean, look at this. Over 90% of all cash balance plans have less than 100 participants. And more than half of all cash balance plans, 57%, have less than 10 participants. So we'll get to strategies and tips and ideas on how you can use this information to grow your business, but you really want to focus on the small business owner.
And just very quickly, why are these plans so appealing to small business? Cost efficiency and tax efficiency. We go into this in a lot more detail in our Cash Balance Coach program, but you can kind of get a sense of the ratio of owners to employees that works really well for testing. Obviously, age-weighted contribution limits makes these plans ideal for older owners who've sunk a lot of assets into the business and are behind on their retirement.
Yeah, I just want to make a quick comment going back to what Martha was alluding to, that ratio. Usually it's like a 10-to-1 ratio. If you have, for every owner, there's 10 employees, cash balance works really well. If there's one owner and 1,000 employees, it might be more difficult to justify putting in a cash balance plan. Asset protection is really important. 35% of all cash balance plans are sponsored by people in the medical group industry. And I find when I talk to doctors about these plans, this is a big benefit, the fact that these assets are, these contributions are asset protected.
Attracting and retaining key employees is really important, and we talk about that a bit later with regards to law firms and medical groups in a highly competitive talent market, but it gives them a really competitive edge to have cash balance plans.
Yeah, and succession planning. I know a lot of advisors and third-party administrators are really interested in learning more about this, so feel free to call me or one of the Kravitz sales consultants. But you can use cash balance plans as a tool in succession planning. Now, succession planning is a much bigger and broader topic, but cash balance plans can play a role in it, a small role, to be truthful. I actually used a cash balance plan here at Kravitz to transfer the ownership of our firm from my dad to myself. So I don't have time today, and I know during other webcasts we've talked about this at more length, but more than happy to speak to you if you have more questions about this, or feel free to give one of the Kravitz consultants a phone call.
And this, again, this is kind of fascinating, and you can go into it in our research report, but this gives you a little snapshot of just some of those Fortune 100 plans, a lot of those with multi-billion dollars, and the medical and hospital group plans, also multi-billion dollar plans. Those are the top. We just show you the top 10 here just out of interest. And again, most of the AmLaw 100 firms do have cash balance plans now. It's highly competitive, and it's just something that top lawyers have come to expect is access to cash balance.
Yeah, I just want to pause here for 1 minute. Again, when you look at the top 10 plans overall, IBM, AT&T, Boeing, FedEx, Bank of America, those were really defined benefit plans that were converted into cash balance plans. When you look at the law firms, though, even though those plans are significant in size in terms of plan assets and number of participants, those plans are more like the small plans that we put into play. Those are really designed to help the partners of these really large law firms reduce their taxes and increase their retirement savings. So I think we're gonna switch gears right now and talk about what's driving all this growth. So, again, we're just showing this slide again to remind you of this steep increase in cash balance growth that occurred after 2012. And just a reminder, we went from about 9,600 plans to well over 20,000 plans. And what I believe, in addition to the cash balance regulations that we got in 2010 that people started to really understand and put into play after 2012, is the tax increases. I'm a big believer that taxes truly drives cash balance growth. In fact, I remember a few years ago, we even hired a marketing firm to interview advisors and interview our clients that were putting these plans into play, I mistakenly thought it was all about saving for retirement. But after getting the data back from this marketing firm, what was really driving the growth was the fact that business owners and executives were looking for ways to drive down their taxes. And we saw a steep increase in activity after 2012. What happened? Remember, taxes went up. After 2012, a whole plethora of new taxes went into play for those people fortunate enough to earn more than $250,000 a year. Let's look. There was a new investment tax. Payroll taxes went up. The cap gains dividend tax went from 15% to 24%. And then if you're fortunate enough to earn more than $400,000 a year, your highest marginal federal rate went from 35% to 40%. And so people were looking for ways to shelter themselves from this increase in taxes. And there's no better way to reduce your tax liability than something called an above-the-line tax deduction, a tax deduction that reduces your adjusted gross income. And that's the beauty of cash balance plans. Making contributions to a cash balance plan reduces your AGI, and therefore it's much more powerful than below-the-line tax deductions like charitable contributions and mortgage interest. Those deductions not only do not reduce your AGI, but they phase out for people that earn more than $250,000 a year. In fact, here at Kravitz, we think this is such a driver that we produce these two handouts, one for advisors and one for potential candidates for these plans that explain these new taxes that went into effect after 2012 in more detail, as well as give two real-life examples, a business owner and a medical group partner, in terms of real-life dollar savings, in terms of how much money we save them in their tax bill by putting in a cash balance plan. So I would encourage advisors that are working with clients to get this in front of them, help them calculate their tax savings. And I usually say this during a kind of a tip I like to give to advisors that are new to this. Don't take our word for it. Talk to your tax accountant about it, because we usually find we're being very conservative in our estimates. And when they actually meet with their tax advisor or their accountant, they find that they're actually saving even more than what we allude to in our materials.
Another factor driving growth is what we call, and what the national media calls, the retirement savings crisis. If you, in any popular media, and then if you follow personal finance online, there's just constantly reminders of how behind the boomers are in retirement savings. And actually now it's all about Gen X being really behind too. So Dan and I are both in the same category there. So this is a really easy issue for so many clients and prospects. And, we always talk about how you can double or sometimes triple your tax-deferred retirement savings by adding a cash balance plan. This is a great chart. We have this on a lot of our marketing materials, and we always highlight the tax savings as well. And then we love that it's now $2.7 million is the amount you can defer over a lifetime in a cash balance plan. You can't have, by the way, we always get this question, you can't have two cash balance plans each with $2.7 million. It's your lifetime limit, essentially. Well, actuarially adjusted.
Yeah. Well, actually, you could potentially have two cash balance plans if you work for two unrelated employers. So actually, here in California, we have a lot of clients we have partners of law firms who also own or potentially are involved in movie production companies. And if the
California.
And if the two companies are unrelated, I've actually done this where we put in a cash balance plan at a law firm, and then we also put in a cash balance plan at the movie production company. And as long as those are unrelated employers, we actually help some of our clients save closer to $5.2 million in their cash balance plan. So I wish we were that lucky to have two successful.
Yeah. Well, once we sell the movie rights to Beyond the 401k, I feel like this is all going to take off for us.
Okay, looking forward to that.
Yeah.
That day. And so in addition to the tax reduction, catching up on retirement savings, recently we've really benefited from a surge in media coverage of cash balance plans. It wasn't too long ago I would go around the country and talk about cash balance plans, and usually I had to spend a lot of my time explaining what it is to people that never heard of it. In fact, I would even get this question, once I started going through the benefits of cash balance, I usually got, this seems too good to be true. This couldn't possibly be legal. And I got this oftentimes, Martha, why didn't I hear about this before?
Exactly.
Fast forward to today in 2017, it's much more fun to go out there and talk about cash balance because I'm actually talking to people who now are somewhat familiar with them. They're comfortable with the fact that these things are in fact legal and that it might make sense to implement this for their client.
Particularly in the small business world and the entrepreneurial world, there's just constantly stuff about cash balance plans. There was an article in Inc. magazine and anywhere you look, and if you just Google search cash balance plans or do a Twitter search, there's so much information available, and I feel like they've finally saturated into the popular consciousness, if you will. So this is what we call the winning hand. Yeah,
so definitely we think it's a winning hand now. You know, where the tax climate is today, I'll talk a little bit about where it might be tomorrow, but where it is today, and because tax rates people feel are relatively high, I know that's somewhat of a controversial statement, but if you believe that, like most people do, it makes sense to have a cash balance plan because of the retirement savings crisis that Martha walked us through, and because of all the positive regulatory changes that we got with the cash balance regulations in 2010 and finalized in 2014, it really is a great time to look at putting in one of these plans for you or your client.
So you add all those together and you have your cash balance winning hand, and that is what we believe is driving that ski jump like growth curve that we love looking at on our slides.
So now we're going to kind of switch gears on you, and this is actually my favorite part of our presentation.
Every part is your favorite part.
Yeah, I know. I have a lot of favorite. You're right. I do have a lot of favorite. I just love everything about cash balance. Oh, for those of you that didn't know, Kravitz in Latin means cash balance. I didn't know if you know that, Martha. But anyway, let's switching gears on you now.
Totally not true.
Yeah. Well, look it up. I just Googled Kravitz. It definitely means cash balance. So now I want to give you some ideas on how you can take advantage of your learn. So we're going to give you, I believe, five. We got
threw in a bonus one today.
Bonus tip.
So I think hopefully we've gotten you all excited about the growth trends, and I'm sure you've already read the whole report. You've gotten some basic knowledge. So now what do you do? How do you get started making this work for your business?
Yeah. So tip number one is you want to focus on the right targets. Martha reminds me all the time, this is not a mass market product like 401k. It's not for everybody. In fact, oftentimes when I go out there and speak on cash balance, I'll typically say it's kind of malpractice to put in a cash balance plan for an employer where the 401k limits meet their needs. The only reason to have a cash balance plan if there's a desire to save more than what the 401k profit sharing allows.
Yeah, so a good guideline. We actually have ideal candidates cards that we can send it. We'll send you guys a link to it, and you can order them for us for free. The business owners should be making at least $250 a year, or in coastal areas probably closer to $350, $400, and you need those consistent profit patterns because of the way cash balance contributions work. It's not like you can just change your amount every year.
Yeah, and definitely business owners that are looking to catch up, you'd be surprised how many business owners really have saved nothing for retirement.
All their money's in the business.
Yeah, they like most business owners, they're constantly reinvesting in their business, usually making, unfortunately, good decisions about their business, bad decisions about their finances, and they need to catch up on their savings. So those candidates are very ideal.
Or when it comes to professional services, people like your doctors and you realize a lot of them were paying off their school loans, then maybe putting their kids through college, and then they've got basically 10, 15 years to save for retirement. Dan usually likes to throw in a joke here about their second marriages and the cost of that, but we'll pass on that.
We'll pass on that joke.
Pass on that today.
I'm not going to say this is a favorite. I'm getting in trouble with Martha on that. But in terms of who is ideal, you really need to focus on your clients that have new comparability plans. Just a reminder, new comparability is a plan design that allows employers to maximize the amount of contributions going in for certain participants. And so I would argue that if you are a TPA or an advisor, you're a wholesaler, and you have clients using this new comparability technique, you really need to introduce the cash balance concept to them. If you don't, somebody else will. So at a minimum, this is a great place to start. This is definitely low-hanging fruit in terms of ideal
not to be a broken record, but all of those professional services firms you should look at if they're already in your book of business or your prospects. Medical groups, CPAs, law firms, financial services firms, usually because of the partnership structure, the profitability level, and the a lot of times you have people who do need to put away more than the 401k limit. And then those are excellent people to look at.
Yeah, and no doubt, successful family businesses, closely held businesses are great for this. Not only are the business owners looking to ways, like everyone, to reduce their taxes and increase their retirement savings, but like I alluded to earlier, you can use cash balance as a tool to help in succession planning. So for that reason, there's no doubt that these small businesses are ideal candidates for cash balance.
This is one of my favorite slides to look at, Dan.
I'm glad you have a favorite, Martha.
Yeah, we do. It's always really interesting to look at. You have this high cluster of medical groups, other medical professionals, dentists, accountants, and lawyers. And then sometimes this is an interesting reflection of the health of the economy, because we'll see little spikes in manufacturing, we'll see little spikes in construction and retail, but those are a pretty small part of the market. But this all other category, which means just any type of diverse business that meets those ideal descriptors of the profitability and the owner's retirement needs, and that's gone up from about 8% a couple of years ago to 11%.
Yeah, and a quick comment here. You notice that, between Office of Physicians and Office of Dentists, the medical industry represents well over 1/3 of all cash balance plans. But if you peel back the onion and drill down on this, you'll find that these are mostly specialty medical groups: radiologists, cardiologists, anesthesiologists, retina doctors. Those are the people that you need to focus on in terms of introducing a cash balance plan. So I usually talk to a lot of advisors and they don't know where to start. Maybe in addition to the new comparability plans, I encourage them, to talk to those particular medical groups. In fact, I even remember, Martha, when I was in my motorcycle accident. Yeah, before I was put under by my anesthesiologist and before my orthopedic doctor operated on my shoulder, I definitely tried to sell him a cash balance plan.
Absolutely. All of our sales team members have pitched cash balance to their various medical specialists. So with some varying degrees of success, I might add. Anyway, just for fun, we wanted to show you what an ever-increasing variety of businesses we do plan designs for, and some of these we do the design and we sell them. So I don't know where you guys are, but where we are, the cupcake craze is insane, and somehow people are becoming multimillionaires selling cupcakes. I haven't quite gotten over that. We did a plan design for a local, probably it's the same everywhere, and it seems to thrive in any economy as bail bonds. The one we did, I remember the one we did a plan design for, their tagline was, "Your mama wants you home." And they were consistently profitable and they met those needs. We have tons of dog grooming, dog bakeries, dog salons in LA, and we have sold a couple of plans in the canine industry. And out here also being LA, we've done quite a few for celebrities and rock bands. And then the tanning industry is huge. And again, those are just some examples. But what we want to say by this is just don't rule out any business. If it meets all those other criteria, don't assume because it's not traditional professional services that cash balance plans might, they may actually be a wonderful fit and make a huge difference in the lives of those business owners and their employees. So.
Great. Thanks, Martha. Thanks for sharing. Particularly, thanks for sharing that tagline of that bail bondsman client of ours.
Hopefully we'll never need them for Dan, but you never know. He gets out there on his motorcycle and it's hard to keep track of him.
Tip number 2, understand that these cash balance plans are combined with 401k profit sharing plans. In order to pass the discrimination testing rules, you really cannot have a cash balance plan without a 401k. A profit sharing plan. In fact, we'll show you a sample illustration that we do later. And oftentimes I get asked by the client or the advisor, we just want to do the cash balance. We don't want to do the 401k profit sharing, usually because a lot of the contributions for rank and file need to be contributed to the 401k profit sharing plan. So well over 96% of all cash balance plans plan sponsors also have a 401k profit sharing plan. So for those advisors and people looking to grow their business in the 401k marketplace, I would argue that cash balance is something you need or should use as a means to win those 401k assets.
Absolutely.
Okay, another really good tip is reach out to the CPA. I've been on many a call with an advisor talking to a prospect about a cash balance plan. And we think we're doing a really good job. We walk them through our illustration, show the business owner how much money they're going to save in taxes, that there's a small additional cost to their employees, but we believe it makes a lot of sense. And usually the call goes really well. After we hang up, and guess what that small business owner typically does? They right away call their accountant, their trusted advisor, to find out if they agree this is a good idea. And unfortunately, one of two things could transpire during that call. One, I've learned, is the CPA is embarrassed that he or she did not bring this innovative idea to their client. So they might share an anecdotal story of a defined benefit plan that blew up on a past client many years ago, and maybe suggest to the client that this is a bad idea. Or even worse, the CPA says this is a great idea, but don't use the folks at Kravitz and that advisory firm that you just spoke to. Use my firm for a cash balance plan, or use my team. So here's my recommendation, and I've heard a lot of advisors say this was a good idea. Find out who your prospect CPA is and reach out to them before you make the pitch to the client. Two positive results typically happen. A, the accountant appreciates being brought onto the team, being brought up to speed. In fact, you might even learn some things about the client that help you do a better job in your presentation. And then secondly, that CPA firm could be a great prospect, or they may have other clients that are good prospects for cash balance. And that's just an idea. Not only might you win this new prospect as a cash balance client, but you might get a lot more business from that CPA firm.
Fourth tip is, which we won't go into detail very much about here, is really learn the basics of cash balance investing, because the principles for investing cash balance plan assets are very different strategies, different principles from investing 401k plans. We've got some really helpful tools. What we captured here was just a slide actually from some data from last year, just showing how some companies have pretty problematic strategies with how their plans are too heavily invested in equities, which can really create some problems. And your role as the advisor is to be able to provide some insight and maybe win some existing cash balance plan business. We have some really great videos on our Cash Balance YouTube channel, that just little 2-minute explainer videos that explain the basics of investing. And this is something you can reach out to any one of our sales partners on. We also do a whole module on this in the Cash Balance Coach program if you want to learn more. But that is a really good way to differentiate yourself.
Yeah, and so no doubt, tip number 5, this might sound a little self-serving, but you definitely want to partner with experts. Cash balance plans are complicated. They're highly technical. We typically find that some of our competition says they do cash balance. Here at Kravitz, we work on well over 1,000 cash balance plans, and then we find out that our competition only has 25 clients that have these programs. So, and we've taken over some of these plans, and to be honest with you, we've had to clean up a lot of disasters. So what I find is, a lot of times an advisor wants to help their client, interview a couple of actuarial firms, which, I think could make sense. And so we've come up with a list of 10 questions, kind of like a mini RFP, that you should consider using when interviewing actuarial firms. So these are 10 questions we would encourage you to ask.
And we'll send you the link to this as well. It's a helpful tool. And it shows your client or prospect that you know how to help them do the due diligence as well.
Yeah, and in addition to giving you 10 questions, of course, we give you our 10 answers, so you can see how Kravitz would respond.
And obviously, we're not trying to make this a commercial for Kravitz, but partner with an expert, however you find that expert, and we would be happy to be that expert for you, but there's lots of other ones out there too.
And so now we're going to shift now, and we're going to talk a little bit about some trends that we're seeing. So I'm going to go through 2 trends that I see going on in the larger marketplace with cash balance. And then, like I said earlier, we're going to go out on a limb and try to make some predictions. So in terms of trends, there's 2 trends that we're seeing. One has to do with the interest crediting rate. We've seen a lot of our larger plan sponsors change their interest crediting rate from something like a fixed rate or the 30-year treasury rate to something called actual rate of return. In fact, in a lot of our larger employers that are thinking of implementing a cash balance plan for the first time are also implementing actual rate of return as their ICR. And I'll explain what all that is. That's a huge trend. A second trend, again with some of our larger clients, is something called strategic plan termination. This has really taken off. Here at Kravitz, we've been doing a number of strategic plan terminations. In fact, these two trends are somewhat tied together. A lot of our clients are actually terminating their cash balance plan and starting a new one to take advantage of actual rate of return as the interest crediting rate. So what is actual rate of return? The way it works is we set up the interest crediting rate to be the actual rate of return on plan assets. There's a requirement in the rules that the assets have to be diversified. So, for example, a mix of bonds and equities would be acceptable, but what would be unacceptable is investing everything in gold or real estate, for example. So you actually use the actual return of the portfolio to be the return in the cash balance plan. The actual return is applied to the hypothetical accounts. The advantage of doing this, and the reason why a lot of our larger employers have switched to actual rate of return, is it eliminates, for the most part, not completely, but for the most part, those annual overfunding and underfunding issues that make cash balance for some of our clients with multiple owners, multiple partners, a little bit more strenuous to manage. The disadvantage of it, and the reason why I don't typically recommend this for our smaller clients, is that volatile returns on the portfolio, a volatile interest crediting rate that might go up and down quite a bit, could impact the discrimination testing. And then there's something called preservation of capital rule you have to contend with. I don't have time today, though I know during our Cash Balance Coach program, during the 201 section, we go into a lot of detail here if you want to learn more. Also, if you want to learn more, we have a great guide, our interest crediting rate guide called More Options, More Choice, More Freedom. It explains what an interest crediting rate is. It goes through, it gives you a nice comparison of the safe harbor options like a fixed rate of something like what we use here at Kravitz, oftentimes 4%, versus actual rate of return. Bottom line, typically for most of our smaller employers, I typically recommend a fixed rate of something along the lines of 4%. And for our larger employers with many partners, I'll typically recommend using something like actual rate of return. So if there's 2 or 3 business owners, with a handful of employees, 4% for the interest crediting rate. If there's, 10, 20, we have a client with 1,000 partners, actual rate of return is probably a really good option. And then last but not least in this guide, I didn't talk about it today, I talked about it in the past, there's even something that's new after 2014, which is having multiple investment strategies within a cash balance plan that uses actual rate of return. If you want to learn more, feel free to reach out to one of the Kravitz sales consultants. Take a look at this wonderful guide that we produce.
We're going to send you a link to this. So I'm getting a lot of these questions coming in. Just to reiterate for all of you, every item or link or handout or video that we mentioned, we're going to send that to you in a follow-up email so you can, along with the slides, so you can just kind of catch up on this kind of information-dense, but hopefully riveting webcast.
Yeah. And then the second trend I want to go to, and I'm really excited about this one for some of our clients, is something called strategic plan termination. This is a brand new trend that I've started to see over the past 24 months. And a definition of a strategic plan termination is when a plan sponsor terminates their cash balance plan and then starts a new cash balance plan. This is a complicated process. So definitely we find that our larger, and it's a costly process. It's not cheap to terminate a plan and start a new one. And it takes there's a cost and time involved. But for our larger and more mature cash balance plans, particularly for our clients that have had a cash balance plan for 10 years or more in particular, a lot of them have gone this route. Now, why would you terminate your plan and start a new one? The reason why it's popular is that it eliminates the liability. A lot of, as these assets grow, we have some clients, with well over $100 million in their cash balance plan. That's a liability on the books for these employers. They want to eliminate it and get that liability off the books. Terminating that plan takes care of that. It's a way to easily change the interest crediting rate. And easily is an interesting word. Again, this is a complicated process. But as opposed to amending your cash balance plan and changing the interest crediting rate, which creates this thing called Wear Away, which I don't have time to walk you through today, but we've written some good pieces on our website about this.
It's a little less than riveting, but fascinating.
Yeah. So in order to avoid something called wear away, rather than amend their cash balance plan to change the interest crediting rate, they just simply terminate it and start a new one with the new interest crediting rate. And last but not least, but probably most important, what drives this is a lot of our business owners are looking to get access to the assets. What I mean by that is they want to take the money out of the cash balance plan, roll it over to their 401k plan, roll it over to an IRA, and self-direct their investments.
And that's also an opportunity a lot of advisors are looking for to get in the door for that wealth management role. So there's a lot of advisors have a strong interest in strategic plan termination as well, or at least bringing the idea to their clients.
Yeah, absolutely. And for our younger business owners, those that haven't reached normal retirement age, this might be the only way to get access to those assets. Mm-hmm. So strategic plan termination is a complicated process. Again, be careful if you go down this journey. I would definitely, whether you're working with Kravitz or somebody else, make sure they know what they're doing. Make sure they've done this before. We're actually going to work on a guide, a strategic plan termination guide, and get that out hopefully by the end of this year. So stay tuned.
There may also be another webcast just on strategic plan termination.
Yeah. So if you find this webcast interesting, hopefully you'll find that one interesting as well. So now we're going to go on a limb and make some predictions.
So normally Dan just wears his Lakers hat around the office, or Dodgers.
Well, not the Dodgers aren't playing well right now. So go ahead.
Just the Lakers. Scratch the Dodgers. But he also has this other hat along with his cash balance crystal ball. And then once a year, when we get ready for this webcast, he puts it on and he makes some predictions. So the first one that he shared with me as it came through this crystal ball was that we're going to see still double digit, but more like closer to 15% cash balance growth for next year. And that's going to be driven by the tax climate, the economy, a little bit of uncertainty, although uncertainty always seems to make cash balance plans do even better. And just increasing awareness that is continuing.
Yeah, and so I talked about this earlier, but I truly believe actual rate of return will be the dominating interest crediting rate for our larger plan sponsors. Again, those are employers that might have 10, 20 or more business owners in the plan. We're definitely seeing a lot of those clients make the switch, terminate their cash balance plan, start a new one, and change the ICR from the 30-year treasury rate or a fixed rate to actual rate of return. I'll go ahead and handle the third prediction as well. There's also a new option that became available after 2014, where if you choose actual rate of return as the interest crediting rate, you potentially could set up different investment strategies within one cash balance plan. I spent a lot of time last year talking about this. This year I'm not going to spend as much time. It's taking a little bit longer than I expected for this to take off. We only have a handful of employers that have implemented this strategy. But I would encourage advisors, TPAs, and wholesalers out there to talk to a Kravitz consultant or read our guides, learn more about it so you're aware of it. It probably doesn't make sense for most clients to have multiple investment strategies in these plans. They definitely make the plan a lot more complicated and difficult to administer, but you want to be the one telling your client about this, and you don't want your competition to talk about it.
It's another one of those door openers. Is like what we try to do with everyone we work with, whether they're TPAs or advisors, is just empower them with things that help you stand out and differentiate. And then one more prediction we'll make that seems to come true every year is just increasing competition, more innovation in the marketplace of cash balance products and services.
In fact, one thing that we implemented a few years ago, and I'm still proud of the fact that I think Kravitz is the only provider of cash balance plans in the small and mid-sized market that offers daily record keeping to our cash balance plan sponsors. So definitely, if you're looking for a differentiator, partner with Kravitz, and we could bring daily record keeping to your cash balance client. I know a lot of doctors and lawyers, when they wake up on a Sunday morning, they want to count how much money they have. So being able to go online to their 401k account, their IRA account, and now also their cash balance account, add those three numbers up, and boom, they know how much money they have for retirement.
And you can link with your 401k account as well. And then the last little item on our agenda is how Kravitz can help you succeed. Here are some next steps. So some of these you may be familiar with, but we just want to refresh for you. Please connect with the Kravitz Cash Balance team. We have our marketing people here, me and Dan and Stephanie. We have our Kravitz consultants throughout the country. We have other new partners we're going to tell you about. And cashbalancedesign.com is your one-stop shop for everything cash balance. Follow us on Twitter. We'll follow you back, and we share lots of helpful cash balance information, and connect with us on LinkedIn.
And for the last 10 years or so, we've been doing free cash balance illustrations for our partners. This is a screenshot of a sample illustration that we did for a small client that had 4 owners and 20 employees. And I'm real proud of our sales process, and our sales consultants are really good at this. We'll help an advisor explain this illustration to their client. We'll help point out all the features, point out the benefits. I usually tell most advisors and TPAs and wholesalers that are new to cash balance, it takes about 10 presentations before you get comfortable doing it on your own. So definitely lean on the folks at Kravitz to do these illustrations. We do them for free. And then after that, let us help you teach your client how cash balance can reduce their taxes and increase their retirement savings.
We have KravitzBackoffice.com for any of you TPAs out there who want to offer cash balance services. We can get you right into the cash balance business. Lots of helpful information there. And
of course, Martha alluded to this, but I would encourage everybody to read our book, Beyond the 401k. You can go to Amazon.com. I think you can get the Kindle version now for like $10.
We have an excellent YouTube channel that we're always adding videos to. Lots of little helpful explainer videos that you can share with your clients and prospects that will explain cash balance in a fun, simple way. And we've got our investment videos and lots of other great stuff there on our YouTube channel.
Yeah, so no doubt we have a lot of tools here at Kravitz, and I'm sure a lot of you are aware that Kravitz joined the Ascensus family this year. And so as a result of that, we believe we're going to have additional tools, additional resources that we can bring to the marketplace with the help of Ascensus to our advisors and clients. So stay tuned. And I also want to share with you, I'm real proud of the fact that this is our 40th anniversary. Kravitz is celebrating its 40th anniversary. My dad started the company on October 16th, 1977.
And we'll have some more interesting historical tidbits on our website about what's happened in 40 years of Kravitz and over almost 30 years of cash balance plans. So for all of you pension nerds and history buffs, check out our website. And just a quick little preview of what's coming up for those of you who are now just determined to really get into the cash balance market. We do our live sessions, which are fully updated from the on-demand version online of Cash Balance Coach. Lots of information on the website. The first one starts on October 3rd. They're all recorded, so if you miss any, you can catch up on them. And what can you do? You can become a cash balance consultant, a CBC. A lot of our advisors that we work with use this as a marketing tool. They run it through their compliance so they can use CBC as a designation. And it just really helps in reaching out to clients and prospects to create that level of trust and confidence that you know what you're talking about when it comes to cash balance.
Yeah, and particularly those of you that are new to cash balance, and I would encourage you to visit our website, cashbalancedesign.com. It's a great website. There's a lot of educational tools on here, case studies, a lot of resources, a lot of the items that I've been alluding to. Martha's going to email links out to everybody, but a lot of that stuff's already here on our website. And last but not least, I know it's 4 hours. It might seem like a lot of time, but it's so riveting. It goes by really quick. Our Cash Balance coaches on October 3rd, 5th, 10th, and 11th will be teaching Cash Balance 101, Cash Balance 201, Cash Balance Sales and Marketing, and Cash Balance Investments. So I would encourage you to sign up at cashbalancecoach.com.
And it is with great pride that Dan and I wrap up this Cash Balance Outlook 2017 at exactly 11 o'clock.
Yeah, we finished perfectly on time. There's
the Kravitz Way, which is the Kravitz Way, on time.
There is a plethora of questions, so I'm going to call an audible right now. I don't have any time to now read and answer questions. So this is what I'm going to do. If you submitted a question, Martha and I are going to go ahead and email you back with answers to your questions. But anyway, I want to thank everybody for attending our webcast. Hopefully we'll see you soon on October 3rd, 5th, 10th, or 11th for our Cash Balance Coach. Feel free to call a Kravitz sales consultant. Feel free to give myself a call, Martha a call, if we can be of any assistance to help you grow your business using cash balance plans.
Thank you very much for your time today, everyone. Have a wonderful rest of your day, and we look forward to connecting with you soon.